Okie dokie. Okie dokie, everyone. Can I just say, first of all, welcome to everybody who is attending tonight's webinar. I'm very happy to see some familiar faces. And secondly, can I start by saying either good morning, good evening, good afternoon, or good night, depending on where you are around the world. Welcome to tonight's webinar. And as you can see, this one is a continuation of How I Came to Understand series. And this one is called How I Came to Understand the Elliott Wave Theory, Part 1. Written by myself, of course, James Trescothick, who's the Chief Trading Educator here at Stratton Markets. Now, before we get on to a bit of an introduction on myself and tonight's agenda, don't forget, of course, we're talking about CFD and online trading. And like with any investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. Now, with that out of the way, this hairy, plump, wrinkly old fellow is yours truly, is myself, as you can see. My name is James Trescothick, like I said, and I'm the Chief Trading Educator here at Stratton Markets. I'm indeed British, as you can hear by my accent, so please don't hold that against me. I have over 20 years experience in the financial service industry. I actually started out at the age of 18, where I was an IFA and I specialized in mortgages for commercial property, buy-to-let investments, before moving into pensions and alternative investments. I then got involved on the online trading arena around about 12 to 13 years ago. And like I said, I have traded myself through a prop company, through Dubai Gold Commodity Exchange, run several floors before moving into portfolio management. And then, of course, I'm actually now, like you see, in education. I'm a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, The Street. I'm an avid market commentator. One thing you would say about me is I'm extremely passionate about the markets, very passionate indeed. I'm very enthusiastic, in fact. I think this all goes down to the fact started at a very young age when I actually watched Wall Street for the first time, and that's when I sort of falling in love with trading, etc. I'm a well-known public speaker, and I've spoken on a number of events around the world, including like Dubai, Singapore, the UK, Berlin, more recently in South Africa. Oops. Now, tonight's agenda is, like I say, it's all about the Elliott Wave Theory. Now, this is part 1 on the Elliott Wave Theory. I will be doing a part 2 in future webinars. But anyway, today we'll be doing part 1. And like I say, first of all, we'll be covering what is the Elliott Wave Theory. Second, we'll be doing what is impulse waves, which is part of the Elliott Wave Theory. Then we'll be talking a little bit about corrective waves. Then the rules of the Elliott Wave Theory, the rules you have to follow for the theory to actually work. And then we're doing a few examples, then future educational events, and of course, the usual question and answer session. And there you go, let me put myself on. Hey, hello, everyone. Good to see you all. Okay. So what is the Elliott Wave Theory? Bit of itchy nose there, sorry. Right, the Elliott Wave Theory. Now, the Elliott Wave Theory was developed in the 1920s by, surprise, wait for it, a man called Ralph Nelson Elliott. Very incredibly creative name. The theory is based upon the belief that the stock market is driven by repetitive cycles, not by chaos. Elliott believed, whenever I say Elliott, I always think of E.T., I don't know about you. Elliott believed that these, Elliott believed that these market cycles were created by traders' reactions to the psychology of the masses. The upward or downward movements in the market he called waves. And he believed if you could recognize these waves, you could predict where the market will go next or might not go next. Now, these so-called waves can be split into 2 categories: impulse waves and corrective waves. Now, impulse waves, Mr. Elliott proposed that the market was in, when the market was in a trend, it moved in like a 5 to 3 wave pattern. The first 5 waves were called impulse waves. In this pattern, the impulse waves we're talking about, wave 1, wave 3, and wave 5 would go where the overall trend was heading. But wave 2 and wave 4 were corrective. So a little bit like this. Now, wave 1, this is where the market initially moves upwards. Okay, this is driven by a small number of people who are buying into an asset. They believe the price is low and it's a good time to buy in. This, obviously, when you've got people beginning to buy something, causes the price of the asset to rise. That's wave 1. Wave 2 is basically enough people, or the original people who bought in, now consider it overvalued and they secure their profits. So they start to close their positions. And obviously, this causes the price to drop below, and this sort of drops a small little wave drop downwards before the market sees the ideal price to start buying in again. So that's wave 2. Wave 3 is usually the longest and strongest wave. The asset at this point has caught the imagination of the masses and it causes the price to surge. And like I say, wave 3 usually exceeds the high first hit by wave 1. So there's wave 1, wave 2, and wave 3. As you can tell, is a lot bigger wave. It's where the price really starts to surge and the masses start to jump in and buy in. Wave 4, let's get to it. Here we go. Wave 4, at this stage, the traders lock in their profits. It's now they consider the assets to be too expensive. This causes the price to drop again, but it's a weak sell-off. Okay, so it's not a strong drop. It's a weak sell-off because there's still a good number of bulls in the market, which leads us to wave 5. Now this level is basically driven by mass hysteria. Okay, and it's the last number of bulls rush into the market, really based on the fear of missing out. You know, they look for any reasons or any explanations to why to buy that asset, and they rush in. This is a sort of time like when you see, for example, magazines with the CEO of the stock of the company whose stock is, you know, on wave 5 in the newspaper, or you see headlines like Bitcoin did last year. You know, we start seeing it on the BBC, the Sun newspaper. This is wave 5 because it pushes the price higher once again, but because it's driven by hysteria, okay, the asset really does become overpriced. And then the market prepares for the sell-off, which then leads to the next stage, which is the corrective waves, also known as the ABC pattern. Corrective waves, ABC. So here's our Elliott wave, our 5 impulse waves. Corrective waves, or ABC waves, are like this. This is when basically the hysteria of that asset has ended. Okay, the market starts coming back to its senses again, you know, starts controlling its emotions again. And it's really the beginning of the reversal of that trend. So wave A is the initial sell-off. Wave B, this is the case when there's just a small number of bulls still left in the market who believes in the asset, and they jump in, but there's not enough of them. So wave B is a slight, you know, jump up when they buy in again, because they're not enough of them, because by this point, wave C then kicks in. This is where the bears really take over, pushing the asset further downwards. Now, there's 3 rules to follow when you're looking for the Elliott Wave theory. Rule 1 is wave 3 should never be the shortest impulse wave. Wave 2 should never fall beyond the start of wave 1. And rule 3, wave 4 should never go to the same level as wave 1. It's a good thing I can say wave, isn't it? My accent is a little bit there. So let's give some examples of live, you know, on the charts we've seen of these Elliott waves. So first one I found is the Amazon. Okay, Amazon. It's the Amazon pattern. This is on a daily. Okay, so I look at this, and straight away I can see there's wave 1. The market initially starts to buy in. Wave 2. Remember, the rule doesn't drop below wave 1. Wave 2 happens, and the initial people buy in, starts to sell in, take profit, which then obviously then leads to wave 3. Remember the rule. Wave 3 is always got to be bigger. Always got to be the longest impulse wave. So wave 3 then kicks in, pushing the asset, in this case the Amazon stock, higher till obviously the initial people who jumped in sell off and start taking some profit, creating wave 4. And finally, the last remaining people of hysteria, seeing the record levels or whatever, the hysteria of the price, buy in, pushing the stock higher, which is wave 5. We then have our corrective waves. We have a wave A, as the market starts to sell off. The last remaining bulls buy in, making wave B, before obviously the trend, wave C kicks in, the bears take over and sell off the stock. So there we can see it there. Wave 1, wave 2, wave 3, wave 4, wave 5, and wave A, B, and C, the corrective waves. Now, another example is even clearer. And this is WTI oil. I was watching this a little time back before the, obviously, sorry, a little thirsty. Watching this back before, obviously, it's gone on a bit of a bull run. So here's WTI oil. Wave 1, nice clear image there. Wave 2, as the market starts to sell off, initial people bought in, take profit. This leads to a big one. Wave 3, remember the rule, wave 3 is always got to be the biggest, longest impulse wave. Clearly it is, pushing the price higher. Then wave 4, as people consider it overpriced and start to sell off. And then finally wave 5, the last remaining bulls jump in, fear of missing out, hysteria. Remember around this time, of course, obviously oil was in the headlines again, pushed it up higher before, of course, the corrective wave kicks in with wave A, it's a sell-off. Wave B, the last-ditch effort of people trying to keep the momentum upwards before obviously then going to wave C. So, those are 2 examples of Elliott waves in practice. And these charts, like I say, I've done today. And like I say, the WTI one in particular, you can really see the Elliott Wave theory in play there. The reason why people try and use, obviously, Elliott Wave theory is to try and identify what wave that asset is on and whether or not they can feel whether or not wave 3 is about to start, or wave 4 or wave 5. Ideally, in the ideal world, you would be watching the pattern here. And if you saw it here and you were confident enough and your fundamentals and your belief based on it, you could believe that actually maybe we're about to start wave 3. And that, of course, potentially could be a good trade. Up and coming educational events. Don't forget, this is part 1 of the Elliott Wave theory. I will do a bigger one later down the line on the different types of triangles with the Elliott Wave theory and how really to use it with your trading. So that'll be part 2 coming up. But for the rest of the month, October the 16th, we have how I came to understand the euro and the British pound as a case study. Then on the 23rd of October, I've got how I learned to trade using moving averages and more other technical indicators. That's a very technical based indicator, that one. And on October the 30th is how I got to know about price action and naked trading. And don't worry, I'm not discussing trading naked in front of your laptop or on your mobile phone. What obviously you do in your own time is up to you, but it's actually a type of trading. If you want to reach out to me, feel free to email me at james@strattonmarkets.com, or indeed you can even direct message me or follow me on my Twitter account, which is @jtriscothic. Now, let me quickly take myself off so you can see the disclaimer. Now, don't forget, we've been talking about CFD and online trading. Like every investment, it does indeed carry a great deal of risk. I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. With that out of the way, I'll go to any questions for anybody. Any questions at all? Everybody at least enjoy it. Oh, good. You actually find it? Okay. Thank you. Thank you, Robert. That's very nice of you to say. I'm glad you enjoyed it. That's good. Yeah, like I say, this is only part one. I will be doing part two very shortly, because I say this is, because it's quite in depth, and it's one of those sort of theories. I like to break it up a bit, because otherwise, if I go on for too long, then you probably get bored and fall asleep. So I will be doing part two on the Elliott Wave Theory, because I find it an interesting theory. Yeah, so I will be doing part two. And here's the thing about the Elliott Wave Theory again. The biggest danger is it because you are relying realistically on your eye, your own identity of the pattern. And some people who trade Elliott Wave Theory swear by it. Others say they're deluding themselves. So like I say, it does rely on your own eye. So as long as you can see it clearly, then obviously it might work for you. Okay, that's an interest. You want to do asking me one to do on Bollinger Bands. Okay. Certainly, John, I will look at doing that. It's not a problem. Is there any other questions or anything else? Any other topics people might like me to cover at all in the future? No? Okay, in that case, thank you ever so much for joining me tonight. I really appreciate it. Big shout out to John and Robert for your questions or your interaction. I do like when you interact, because otherwise it gets quite lonely. I hope you enjoyed tonight's episode. Like I say, don't forget about next week, the new episode. And anyway, till then, can I wish every single one of you either a good morning, good afternoon, good evening, or even a good night, depending on where you are around the world. Till next time, every single one of you, trade safe.